Picture this. You're 65 years old, you've worked hard for 40 years, and it's your last week of work before you retire. You've amassed a nest egg worth $750,000, and you plan to spend $5,000 per month to maintain your lifestyle. Your Social Security will give you $2,500 per month, so you need another $2,500 per month to pay your bills and enjoy your retirement. So how do you structure your investments to cover your income needs and grow over the long term? I will show you how in this video. There are a lot of financial gurus on YouTube, but are you listening to a qualified professional who has actually helped somebody else retire successfully? I have spent the last decade of my life not only studying finance, but I manage millions of dollars for our clients who are approaching, newly, and in retirement. I know exactly how to build an investment allocation that will last 30 to 40 years and beyond. And today, I'm going to share our strategy. Before I get started though, please be sure to like and subscribe to our channel. This helps us get this information out to as many people as possible, and we thank you in advance. So why do you need to reconsider your investment strategy upon retirement anyway? Can't you just keep your portfolio as is and pull income as needed? Well, that depends. The biggest investment risk retirees face is something called the sequence of returns risk. This is a phenomenon that involves the order and timing of poor investment returns and the timing and size of your withdrawals. Let's say that you had $750,000 in your nest egg and you retired at the beginning of 2022. You were invested exclusively in the S&P 500 index, and you pulled $3,000 out per month or $36,000 that year to maintain your lifestyle. The S&P 500 lost roughly 19%. So this means that you didn't just lose 19% for the year, but you lost 23.8% because you also pulled 4.8% out as income. When you tap into your portfolio as it's losing value at the beginning of your retirement, your chances of running out of money over 20 years are significantly higher than someone with the same amount of money in withdrawals that experienced a bullish first few years of retirement. Because no one can control the sequence of returns of the stock market, it's crucial that you segment or bucket your money based on your income needs over different time frames. This way, your lifestyle is always protected. So you're familiar with our bucketing strategy and understand that there are 3 buckets of money. The green bucket, or the money you'll need during the first 3 to 5 years of retirement, the yellow bucket that will fund years 5 through 15, and the red bucket which will fund years 15 plus. The buckets get more aggressive as the time frame increases, and you must rebalance every several years to keep these buckets replenished. Now I'm going to show you exactly how I would bucket your $750,000 to provide that remaining $2,500 per month you need to maintain your lifestyle. Accounting for 3% annual inflation, you'll need roughly $150,000 in bucket 1, $400,000 in bucket 2, and the remainder of $200,000 in bucket 3. In bucket 1, I would invest $50,000 in a high-yield savings account currently yielding 4.5% per year and fully liquid. I would invest $50,000 in a 1-year CD yielding 5.5%, and I would put the remaining $50,000 in a 3-year multi-year guarantee fixed annuity yielding 5.35% per year. So the overall yield of bucket 1 is 5%. In bucket 2, we need to split the $400,000 between fixed and stock. So I would invest $200,000 in a 5-year multi-year guarantee fixed annuity yielding 5.5% per year, and $200,000 in a stock index portfolio comprised mostly of low-cost ETFs. So the overall average return of bucket 2 is 5 to 8% per year. With the remaining $200,000 in bucket 3, I would invest in a very similar ETF stock portfolio comprised of low-cost index funds and some sector funds if you want to be more aggressive. The overall average return of bucket 3 is 7 to 10% per year. The yield from bucket 2 will automatically replenish bucket 1, so you can stave off pulling principal from bucket 2 for as long as possible. Every 10 years, you will trim bucket 3 to replenish bucket 2. This allows you to enjoy yourself without worrying about the stress of the stock market's volatility and your ability to fund your lifestyle. You might notice in watching these videos that the larger your nest egg, the more you can spend, and vice versa. Also, it's okay to slightly modify these buckets' timeframes. For example, if you're a more aggressive investor with a larger nest egg or lower annual expenses, your green bucket can cover the first 3 years of retirement instead of the first 5. These buckets are meant to keep it simple and provide a framework for investing prudently in retirement. One last point. The ideal time to bucket your money is actually 2 to 3 years before you retire. You don't want a bad market year just before retirement to delay your retirement date. Thanks so much for watching. If you found this video helpful, please like, subscribe, and comment below. I try my best to get to your comments as soon as I can. And if you're approaching or newly retired and you need help preparing, please reach out via our website or by calling our office. See you soon.